In less than 6 hours, over $800 billion vanished from the crypto market. Traders were caught off guard. Panic swept through exchanges. What caused one of the fastest and most brutal crashes in recent memory? Buckle up. The answer is far more shocking than you think. April 7th, 2025. A day that shook the crypto world. Prices of major cryptocurrencies nosedived in just a matter of hours. Bitcoin dropped below $80,000. Ethereum plunged over 11%, and the altcoin market followed in a massive red wave. But what triggered this sudden collapse? Why did the market crash today? And what does it mean for investors going forward? Let's break it all down. The primary cause of today's crash can be traced back to a major geopolitical development: a new wave of tariffs announced by the US government. Earlier this morning, the Trump administration unveiled aggressive trade measures targeting key global economies. These included a 34% tariff on Chinese imports, a 20% tariff on goods from the European Union, and a 24% tariff on imports from Japan. This announcement rattled global markets. Investors around the world began to fear the return of a full-blown trade war. The ripple effect was immediate. Stock markets reacted sharply. US S&P 500 futures fell by more than 5%. Over in Asia, Japan's Nikkei index dropped by 6%, while the Hong Kong Hang Seng index took a steep 9% hit. These aren't small corrections. These are signs of serious investor fear. And when traditional markets panic, crypto often suffers alongside them. Despite the idea that cryptocurrencies operate outside the global financial system, the reality is that today's market is deeply interconnected. So why did crypto fall so hard, so fast? One reason is the growing presence of institutional investors in the crypto space. Hedge funds, large-scale investment firms, and even banks now treat crypto assets like any other investment in their portfolio. When stocks fall and fear spreads, they tend to sell off high-risk assets first, and crypto is high on that list. Over the past 24 hours, more than $840 million worth of long positions were liquidated across the crypto market. That's a massive amount of money exiting the system in a very short time. Once the downward momentum started, it became a chain reaction. Bitcoin, the market leader, dropped below the key psychological level of $80,000, hitting lows around $79,000 before stabilizing slightly. Ethereum saw even steeper losses, plunging 11% to around $1,592. When Bitcoin falls, the rest of the market usually follows, and today was no different. Dogecoin, Cardano, Avalanche, and other altcoins all recorded significant losses. But it's not just the numbers that matter, it's the psychology. When markets crash, fear takes over. Traders panic. Retail investors rush to sell, often at a loss. Social media amplifies the fear, with thumbnails screaming "crypto is dead" or "the bubble has burst." This emotional response can cause more damage than any single policy announcement. Today's crash wasn't just technical, it wasn't just political, it was psychological. Now, here's something important to understand. This isn't the first time crypto has experienced a sharp drop, and it probably won't be the last. We've seen this before. In 2018, the market collapsed after a long bull run. In 2020, the COVID-19 pandemic caused panic selling across all financial markets, including crypto, and yet each time the market recovered, often stronger than before. So the big question is, will this be different? That depends on what happens next. If the trade tensions escalate, if more tariffs are introduced, or if other countries retaliate, we could be in for a longer period of market uncertainty. That would mean continued pressure on both traditional assets and cryptocurrencies. On the other hand, if diplomatic solutions are found and global markets begin to stabilize, crypto could recover faster than expected. After all, long-term fundamentals like Bitcoin halving cycles, growing adoption, and institutional infrastructure are still intact. So, what should investors do right now? First, don't panic. Panic selling almost always leads to regret. If you sell out of fear, you're locking in losses that might otherwise recover. Second, evaluate your risk exposure. Are you over-leveraged? Are you invested in high-risk tokens without a clear use case? Now might be a good time to rebalance. Third, keep a long-term perspective. Cryptocurrency has always been volatile. The people who succeed in this space are usually those who can weather the storms, not those who chase every rally or dump at every dip. Finally, stay informed. Markets react to headlines, and in times of crisis, information becomes your greatest asset. Follow reliable sources, understand the macro trends, and don't get caught in the noise. Today's crash is a wake-up call, not just about market volatility, but about how interconnected our financial systems have become. A political decision in Washington can now shake wallets across the world, digital and otherwise. But in every crisis lies opportunity. For those who understand the game, this could be a buying opportunity. For others, it's a lesson in risk management. Either way, what you do next matters. So, as the dust settles and the markets digest this latest shock, remember, crypto is not dead. It's just reacting, like everything else, to a complex and rapidly changing world. Stay sharp, stay patient, and stay smart.